So, what if the next global financial crisis wasn't some kind of bug, but a feature of the system itself? Today, we're going to dive into a pretty wild theory called the economic singularity. It's all about a predicted financial reset that gets kicked off by a perfect storm, a real-world supply shock, a massive hidden vulnerability in the financial system, and then the rollout of a brand new financial infrastructure. Let's break it down.
Right off the bat, the core idea here is really provocative. This theory suggests that financial crises aren't just accidents we're trying to avoid. Nope. Instead, it says they are a deliberate feature, a kind of planned demolition that allows those with access to basically unlimited liquidity to systematically buy up real assets from everybody else at a huge discount.
Okay, so how could that even be possible? Well, the theory argues it all starts with what it calls the illusion of value. You see, central banks control the cost of money by setting interest rates. When money is cheap, assets feel valuable. When money gets expensive, they don't. From this point of view, the currency in your pocket is actually a tool, one designed to slowly lose its value over time, making you more and more dependent on the very system that's devaluing it.
And that brings us to the main event, the economic singularity. Try not to think of it as just another market crash. It's more like the entire measuring stick we use for value just breaks. It's a theoretical point where all the metrics we rely on, stock prices, bond yields, GDP, they all just become completely meaningless. Value isn't just lost. The very definition of value gets rewritten.
All right, let's move from the abstract to the real world. According to the source for this theory, while we're all busy watching financial charts and derivatives, the real trigger is going to be a breakdown in physical logistics, specifically a blockade of the Strait of Hormuz. This, it argues, is the first domino that's set to fall.
And the scale of this problem? It's just staggering. A blockade here wouldn't be some minor hiccup. The theory says it would instantly vaporize 7 to 9 million barrels of oil from the global market every single day. That is a deficit so massive that no strategic reserve, no production increase anywhere else in the world could possibly fill that gap. It's simply irreplaceable. Now here's a really crucial detail from the theory. The first major red flag you'll see, it won't be the price of crude oil on the news. It'll be the price of jet fuel. So why jet fuel? Because apparently it has extremely low inventories and it's highly illiquid, which just means it's not traded as easily. It's the system's weakest link, the real canary in the coal mine that'll signal the crisis is here before most people even know what's happening.
So this physical shock in the oil market is what's supposed to ignite a massive, hidden financial time bomb. And the epicenter of that bomb? Japan. This brings us to what this theory claims is the linchpin of the entire financial collapse, something called the Japanese carry trade.
So what on earth is the Japanese carry trade? Well, imagine for a second you could borrow money for practically free. For decades, that's exactly what big institutions have been doing with the Japanese yen. They borrow literally trillions of yen at near zero interest. Then they swap it for dollars or euros to buy things that actually pay higher interest, like US government bonds. It's been the main artery of cheap money, just pumping liquidity into global markets for years.
And here's how the dominoes fall, with terrifying speed. First, the Hormuz blockade happens, and oil prices go through the roof. For a country like Japan that imports almost all its energy, this triggers insane inflation. So, the Bank of Japan is forced, absolutely forced, to hike interest rates in an emergency meeting. All of a sudden, that free yen isn't free anymore, and what follows is a global panic, as everyone scrambles to sell their assets to pay back their yen loans. Trillions of dollars just evaporate from the markets, and the system that banks use to lend to each other, the interbank market, it just freezes solid. The source claims this all happens not in weeks, not in days, but in a matter of hours.
So what happens when the markets freeze like that? Well, it means liquidity just vanishes. Poof! Money stops moving between institutions. And in our modern financial system, if money can't move, the whole system just dies. The ability to settle a transaction, to actually finalize a payment, it's no longer about efficiency, it's about pure survival.
And this is the core danger right here. A bank isn't really a building. It's a web of promises. And if it can't settle its payments, if it can't make good on those promises, it effectively just ceases to exist. The entire game changes in that moment. And survival comes down to one simple thing: who can settle transactions and who can't.
This existential crisis, the theory argues, is exactly why a controlled transition to a totally new kind of financial plumbing is needed. We're talking about a system that's not designed for normal, everyday times, but for these extreme moments of panic where all trust is evaporated and settlement is the only thing that matters.
Okay, so here's the crucial difference. The old system, on the left, takes days to finalize a big payment. And in those days, there's always a risk that the other side of the deal could go bankrupt before the money actually arrives. That's called counterparty risk. The system proposed by the source, on the right, well, it's designed specifically to eliminate that risk. It can settle value instantly, 24/7, meaning the transaction is completely final the moment it's sent. In a full-blown crisis, that difference isn't just a detail, it's everything.
So, if any of this theory holds water, how would a person even navigate such a massive shift? Well, the source material doesn't just outline the crisis, it actually proposes a strategic roadmap, focusing on assets that it believes are built for this new world.
The strategy it describes is basically twofold. The first layer is the utility infrastructure. These are the digital assets designed for settlement and for cross-border payments. The second layer is what it calls physical anchors, assets like physical gold and silver, which, have historically been seen as stores of value completely outside the traditional financial system.
So to wrap up, this whole theory suggests that all eyes should really be on one place. Not the Federal Reserve, not the European Central Bank, but the Bank of Japan. Why? Because its policy decisions, especially on interest rates, are presented as the direct trigger for the unwinding of that massive carry trade and the beginning of the entire cascade.
And so we're left with the central question this theory forces every one of us to confront. If the paper wealth that we've built our entire world on is really just an illusion waiting to disintegrate, then what is real value?